All right, let's jump right into this explainer. Today, we're going to explore the absolutely fascinating fundamental relationship between central bank interest rates and the price of gold on the XAU/USD chart. We're really going to unpack the nuts and bolts of this relationship. You know those violent market expansions and dramatic candlestick reversals you see during major trading sessions? Well, we're going to look at exactly how massive macroeconomic shifts create those. We're relying directly on insights from heavy hitters like Bullion by Post and the Royal Mint to translate these traditional financial concepts into, well, actual actionable insights for the live markets.
It's honestly kind of mind-blowing when you stop and think about it. How exactly do decisions made by a handful of policymakers sitting in a boardroom dictate the value of a major commodity traded on digital screens all over the world? As traders, we really can't afford to just sit there and guess the market direction, right? We have to understand the macro bias. These boardroom decisions effectively set the overarching trend and the inflation expectations for the entire global economy. This means understanding central bank policy isn't just background noise you can ignore. It is literally the fundamental narrative that determines whether massive institutional capital is rotating into or pulling out of gold.
Okay, moving to Section 1, the interest rate seesaw. Let's look at the core relationship.
To really wrap our heads around this, you have to picture the financial world as just a giant seesaw, where the balance of power is constantly shifting back and forth. The crucial point here, established by groups like the World Gold Council, is a traditional negative correlation, and this is driven by a very specific intermediary, the US dollar. So here's the step-by-step chain reaction. When central banks raise interest rates, it generally leads to a stronger US dollar. That stronger dollar puts gold under massive pressure, sending prices down. Conversely, when rates go down, the dollar weakens and gold tends to shoot up. They basically move in opposite directions. Understanding this specific chain reaction is exactly how you start anticipating those major structural trends you see printing on your trading charts.
On to Section 2, when interest rates rise. We'll call this one the thriving economy.
So why do rates actually go up? Well, they usually rise for two distinct reasons. The first is simply a thriving economy. Confidence is booming, businesses are expanding, and central banks raise rates just because the cost of borrowing naturally goes up in high-demand environments. The second reason, though, is inflation control. If prices are just skyrocketing too fast, central banks will raise rates to hit the brakes. They want to encourage people to save their money rather than spend it. Now, here is what is absolutely crucial for your trading psychology. Markets are forward-looking. Institutional algorithms are constantly trying to price in these rate hikes long before the actual central bank even makes an announcement. And that anticipation, that's exactly why we so often see highly erratic candlestick behavior and messy consolidation zones leading right up to a big news release.
And this brings us to a huge driver of those charts, opportunity cost. Just look at the dynamic in play here. Gold is a commodity, right? It doesn't produce an annual yield. It doesn't pay you a dividend just for holding a position. So think about it. When government bonds and savings accounts are suddenly paying out high guaranteed returns because of rising interest rates, holding gold becomes fundamentally way less attractive. That lack of yield is the core reason why we see heavy, undeniable bearish structure forming on higher timeframe charts whenever Treasury bond yields spike.
Ultimately, in these high-rate environments, the domestic currency gets stronger, and that psychological need for a financial safe haven completely vanishes. Investors aren't scared, so they just aren't buying gold for protection. But listen, here is where risk management really comes in for you as a trader. Even if the overall macro bias is heavily bearish because of rising rates, you absolutely cannot just indiscriminately short the market. You have to wait for the crazy volatility from the rate announcements to settle down. You confirm the fundamental direction by looking for breaks in market structure and sweeping liquidity levels before you even think about entering a short position.
All right, Section 3, when interest rates fall, the stagnating economy. Now, what happens when we flip the script? In this scenario, the mechanics totally reverse, and we see a very specific chain reaction that traders absolutely love to capitalize on. Step 1, economic growth stalls out. Step 2, central banks step in to try and stimulate that dying economy by slashing interest rates. Step 3, this drop in rates leads directly to a weaker US dollar. Because the economy feels shaky and the currency is losing value, institutional money panics. It literally flees into safe haven assets. And this massive spike in demand translates into aggressive, unmistakable bullish momentum right there on your XAU/USD charts.
All of a sudden, that opportunity cost we just talked about flips completely in gold's favor. With interest rates sitting near zero, those alternative investments aren't producing any exciting income anymore. So gold's lack of a dividend, it isn't a disadvantage at all. If you want a real-world example, just look at the unprecedented emergency rate cuts central banks made back in 2020 during the global shutdown. You can clearly see this theory in action on the charts.
Rates were slashed to near zero, and the XAUSD chart responded with sharp, historic bullish expansions as money piled into the ultimate reliable store of wealth. It's like textbook macroeconomics playing out live.
Section 4, Central Bank Influence. Time to talk about the heavyweights.
So while different nations obviously have their own rates, like the Bank of England's Monetary Policy Committee making their 8 scheduled annual decisions, it's vital to recognize the sheer psychological impact these meetings have. When sudden macroeconomic shockwaves force a central bank into an emergency discussion or they drop an unexpected rate hike, volatility just goes through the roof. For us traders, this highlights a critical piece of trading psychology. You can never, ever let emotions dictate your actions during these shockwaves, and never trade the news blindly. Seriously, blindly guessing the direction during sudden policy shifts is exactly how trading accounts get blown to zero.
But listen, when it comes to XAUUSD, the U.S. Federal Reserve, the Fed, is the undisputed heavyweight champion. It is the ultimate market maker. Because physical gold is predominantly traded globally in U.S. dollars, whatever the Fed decides to do to the dollar directly impacts your gold chart. The general rule of thumb, when the Fed hikes, gold drops. When they cut, gold shines. But how do you actually trade a Federal Open Market Committee or FOMC meeting? Well, you use reaction-based setups. A lot of the time, the initial rate release causes a massive spike in one direction, only for the press conference 30 minutes later to reverse it entirely. These are those infamous whipsaw candles that absolutely liquidate impatient traders. Professional risk management says you sit out that initial news spike. You sit on your hands, wait for the dust to settle, and only look for clear structural breaks that confirm the new macro bias before taking your position. So, knowing just how heavily these macroeconomic policies dictate those massive XAUUSD expansions and reversals, I want to leave you with a quick question to answer below. Do you prefer to trade gold right before the interest rate news drops, trying to aggressively catch that initial volatility spike? Or are you the type to wait for the market to settle and trade the newly confirmed structural direction after the event? Let us know your strategy. Thank you so much for joining me for this explainer. Stay disciplined out there, and as always, respect the macro bias.